So what we're doing in the portfolio, we're still going for value. We're still trying to find stocks that are both attractively valued from a risk-return perspective, as well as delivering an attractive level of income. What that's meant for us in the portfolio over the last year has been a continued focus on stocks outside the US, where we think the valuations are much more attractive, and the income advantage they have for their investors versus the alternatives is just so much larger in Europe or Asia compared to the US. In Europe, if you look at the number of companies that are paying more in their dividend yield than their own corporate bond yield, it's something like 85%. In the US, that's less than 20. So there should be a good opportunity for those companies either to continue to push their dividends up, for the market to re-rate the shares because the dividend yield advantage is so large, which would lead to the share prices going up, or, and what we've seen so far in the US over this equity cycle, is companies issuing debt to buy back shares because they can reduce the cost of their dividends that way. So we haven't seen that happening a lot in Europe so far, but it is a significant opportunity going forward. But crucially, we just think it makes for a much more attractive investment in Europe. Europe, if you're a bank depositor or you're buying a government bond, you're still getting basically a zero yield. Whereas plenty of the European companies we're buying have 4, 5, 6% yields, which we think are really compelling. We think those yields are sustainable. The companies are showing an ability to grow them over time because notwithstanding a slower year for profit growth in 2018 than the really fast 2017, they're still growing profits. Dividends are still going up. The other thing that a more volatile environment is providing us for, we can use some derivatives to convert some of the stock return into a more attractive income focus. That may provide us more downside protection. It may involve selling off some of the upside to deliver more income yield. And the more volatile environment, certainly on some stocks, has led to more attractive pricing opportunities in the derivatives market, which means that when we do pursue some of those strategies, we get a better return for it. So that's one that it's still incrementally changing, but we're certainly seeing some more opportunities for that. So we think dividends have always been a critical part of shareholder returns over time. And while in some parts of the world, most notably the US, we've already seen rates go up and bonds are now a real alternative for people, cash at the bank is now a real alternative for people. In other parts of the world, that still hasn't happened. The ECB's deposit rate is still minus 40 basis points. Japan's still got 0% interest rates as well. So what we're doing in the portfolio is we've also tilted somewhat more to the defensive sectors. So you've got more exposure to areas like healthcare and utilities than we had a year ago. So that's an advantage for the portfolio going forward if we do head into less strong economic growth. But you've got other areas of the portfolio, such as financials, which can actually benefit from the volatility, can benefit from the rate rises. They certainly haven't seen it yet, particularly the Europeans, but also some of the Asian banks. And then the energy sector is another one, which notwithstanding the oil prices come off a little bit in the last 6 weeks or thereabouts, we still think those companies offer very attractive dividend yields versus the rest of the market.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。